Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The conflict in Ukraine has been felt right around the world. While we know financial markets are affected by geopolitical events, the actual impact varies between commodities, bonds, equities, and even then, it's sector by sector. We've spoken on a number of occasions now to Wilson Asset Management, and today I wanted to get a feel for how equities are being impacted by the conflict. John Ayoub is the portfolio manager at WAM Leaders, that's Wilson Asset Management Leaders, and joins me this morning. John, welcome to Fear and Greed.
Good morning, Sean, and thanks for having me.
So broadly speaking, how have equities fared over the past couple of weeks since the conflict began?
Surprisingly well. There's a few things at play right now which I'd probably characterise that we're in the eye of the storm. So things aren't seeming as bad as what they potentially may be. So we're still rolling off COVID from last year and the last few years, I should say. And the rate complex where people are constantly talking about what the Fed's going to do and what the RBA is going to do over the coming 12 months, they're still dictating the direction of the markets. And Ukraine-Russia conflict adds another layer of complexity. So as we start to kind of meander through trying to work out the recovery of earnings for corporate companies, and we came off a very strong reporting season in Australia and America where companies highlighted some strong rebounding in earnings, very good cost discipline. We start to look at the consumer and corporate and nations as very strong and very stable positions. So with that backdrop, we think the world can absorb some rate hikes. But here's the but. As we start to consider what Ukraine and Russia put into the mix, we're going to see some serious inflation. Some concerns have started to hit the market around what that means for growth, what that means for the outlook of economies. So with that context, people start to price in less rate hikes over the next 12 to 18 months. And with that, people get a little bit more excited around the outlook for equities. But we still think that if we consider the comments last week from Jerome Powell, he still sees rate hikes in the US coming as early as March and significant rate hikes above 25 bips continuing through the course of the year. This will put pressure on equity markets. So you throw that in along with the pressure inflation is going to put on the outlook to growth. We think there could be some turbulent times leading some pressure on equity markets for the next 6 months in particular.
Okay, it's a really good point because the US Fed Reserve Chair Jerome Powell, as you said, he wants to keep raising interest rates. Now, he's doing that because the economy is recovering. Certainly in Australia, we've had some really strong economic growth figures last week. The flip side, though, of course, as you mentioned, Ukraine, and even potentially a new variant of coronavirus too, it must be difficult to know exactly where to go as an investor.
Absolutely. We characterise it as a game of 3D chess. You're trying to play chess on three different planes and trying to juggle COVID, rates, and Ukraine, Russia. So what we try to do, you need to adjust as new information comes. You can't really set a course today and expect that to be held true for next week, let alone next month or next quarter. So as information evolves, our job as equity investors is to process those and come out with new conclusions if that's necessary. And we've had very good times in equity markets where a lot of easy money has been made on the back of, on cheap money effectively. And we think though it's going to get a little bit harder from here on in. So it's going to be a lot more, you need to do a lot more DD around companies to see how their ability to sustain the inflation, how their ability to pass on that inflation to customers, what their balance sheets look like if rates start to head up and their cost of debt starts to sneak up. So there needs to be a lot more discipline in the way that you spend your money effectively.
Yeah. So if we think about the energy sector, oil and gas particularly, at the moment, we still have gas flowing between Russia and the continent. This whole disruption to energy seems to be a really critical piece of it because of inflation. Is that right?
There's two sides to this coin. And the first one is Russia is about 11% of global oil and gas supply. And it's around 40% of Europe's gas supply directly for energy consumption. So energy security is at the forefront of everything that nations are doing. And you've even seen President Biden come out and he's unwilling to put sanctions on oil yet. $115, $120 oil doesn't help anyone really other than the oil producing countries and the oil producing companies. So what you'll want to see is political pressure will try to get those oil prices and gas prices in particular down. But that's easier said than done. Energy security now is at the forefront of everyone's mind. And if you kind of consider what the Chinese policymakers have come out this week, they're ambivalent to price. They just want supply. And very rarely do you see a nation come out and say, hey, do whatever it takes to get it. Don't worry about the price. And that's what we're hearing. We're hearing those anecdotes. So what potentially could kind of stumble the oil price, an Iranian nuclear deal could lead to more supply coming into the market. But what we've seen over the last 3 to 5 years is a material underinvestment in energy. The world's been fixated, and rightly so, on shifting to green energy and finding alternative sources. But there is a mismatch in duration when you start to consider these elements. And there is also a mismatch in economy. So you've got developing worlds versus developed worlds that can afford the investment in green energy versus developing nations, which is it's a long way away before they can shift from the consumption of coal and gas and oil towards greener alternatives. So it's a really interesting place we are, because I can't see oil or gas prices coming back in a very significant way anytime soon. Now, albeit a resolution in Russia could help that, but what it does, it highlights and underscores the need for countries to shore up that supply, to ensure that there's adequate resources to get them through this period of transition, however long that transition will take. Now, the flip side of that coin is these prices do make you consider how quickly we can shift to green energy sources and where that investment comes from. Because where the energy prices are today, and you kind of look at where Australia is, and we're building snowy hydro and other things to kind of help combat the need for coal. Previously, the tipping point and the cost of replacement didn't make any sense. But as coal starts to spike up, oil starts to spike up, gas starts to spike up, those replacement equations become a little bit more balanced, and you could see corporate world and private investors willing to fund it as opposed to relying on governments. And that's where the biggest debate has been. Who's going to fund this transition? And if you can make an economic return, ultimately that's what everything comes back down to, you could see that shift from oil and gas towards those greener energy sources. And that could be one of the positives. And I kind of hate to trivialise what we're going through. This could be one of the positives that comes out.
Okay. Stay with me, John. We'll be back in a minute. My guest this morning is WAM Leaders Portfolio Manager, John Ayoub. So if we get away from the energy sectors, things like technology stocks, I'm a bit confused by what's happened with them recently, in as much as they're relatively safe assets to some extent, but they've certainly been sold off. Healthcare's the same.
Yeah, look, you're right in some respects, but valuation is ultimately what drives everything. And the rate dynamic kind of drove them up and will drive them back down. There are tech stocks and tech sectors which, if you think of Google and the like, they're core to everything we do now. However, there's other stocks which are more sensitive to consumers. They're more sensitive to GDP. And they're definitely more sensitive to the rate environment where, if we start to increase rates to what bond markets are predicting, the valuations will pare back significantly. So we saw at the onset of the conflicts in Russia and Ukraine, forward pricing of rate markets pull back, and expectations around 6 or 7 rate hikes in the US pull back to 4 or 5. That actually gave a little bit of a kick to the tech sector. But with comments that we saw from the Fed last week, they kind of highlight that, no, rates are still going to march forward, and now we have to question valuations. When it comes to healthcare, it's a similar vein, but it's a defensive. It's a pure defensive. So within healthcare, and my comments earlier about you got to be really selective on stocks. There are a number of stocks that are going to be, are going to come off COVID headwinds. They're going to come off. They're going to be certainly see a significant investment from governments, as Ramsay Healthcare in Australia is one in particular, where it's come through a very difficult time. But if we kind of forecast 18 months forward, it's well positioned. So you need to really be selective in stocks within sectors. So previously people would just buy a basket and they'd all go up for one reason or another. I think nowadays you need to be more considerate about the individual stock as opposed to buying individual sectors.
John, since I've got you, I'm now going to ask you, what stocks do you like, if that's the case?
The Leaders Portfolio, we hosted a webinar last week. I outlined a lot of our preferences from a sector perspective. So you can find that on the Wilson Asset Management website, the little plug there.
Yep.
We're fairly defensive. We're sticking to quality, and I think what we characterise our portfolio right now as quality. The companies that have the ability to kind of combat inflation or pass those on to consumers. Firstly, we're very long commodities, BHP, Rio, South32, AWC, got a lot of Santos. So our sector still is heavily geared towards that, and I'll come to reasons why on that later. But other sectors like staples, so Woolworths and Coles, they've come through a fairly difficult time from a cost perspective, and Coles in particular has shown their ability to offset those costs rather quickly. So Coles, Woolworths, high quality businesses like Treasury Wine and Endeavour, there's a bit of a theme here.
Yep.
And then if you kind of look at the industrial world, things like Brambles, Wesfarmers, in healthcare, Ramsay Healthcare, CSL. A lot of these stocks are the backbone of our portfolio now.
Yep.
And we think they should be able to deal with a lot of the global headwinds that we're facing over the next 6 months. But in saying that, in regard to the tech sector, there's opportunities arising. And what you want to typically do is try to find the best stock in each sector that previously you may not have had an opportunity to buy because of valuation. Dislocation and volatility provides opportunity.
Yeah.
And so we've certainly got our eye on a lot of names. I'll call out realestate.com as one,
Yep.
where we think it's an incredible franchise. Even Seek. These are really good businesses where valuation was a little bit stretched over the last 2 to 3 years. But that doesn't say that these businesses aren't market leaders. They absolutely are.
Yep.
So they're names that we put on the radar. We put little positions in. And if we're right in our thinking that valuations come under more pressure, these are names that we'd look to increase our stake in.
Okay. You mentioned Santos there. Just one final question. How do you judge oil and gas? I mean, I fully appreciate what's happening in the Ukraine and to oil and gas prices. So certainly it's a trading play. Is the long-term outlook for these oil and gas guys, though, particularly if they're not transitioning, and Woodside's another example because it's taking on all BHP's oil assets, what is the long-term play for these guys?
Santos is taking steps to shift more and more to green energy and carbon capture. And so they're doing their part.
Yep.
I think if we take a step back and kind of consider the dynamic and how long it will take for this energy transition to take place, countries like Norway have been able to do it quickly. Australia potentially could do it quickly. The US, who knows how long it takes. But if we consider China, if we consider India, if we consider Korea, very large markets, it's going to take a long time to see a trend. And if you think about the continent of Africa, it's going to take a long, long, long time for these countries to transition.
Yeah.
And if you look at the capex budgets of all the major oil majors in the world, they've been shrinking at a rapid rate. So there is a place for oil for the next 20 to 30 years.
Yep.
The thing to also remember now is if what Russian conflict has highlighted is energy supply and the security of supply and who you partner with. Because geopolitics, we got a little bit lazy, so to speak, where you kind of had a project in Mozambique, or you have a project here or project wherever it might be, and you just expect them to come to market. So if you consider Santos and Woodside in that context, Australia is a really good place to be.
Yeah.
You know that politically we're stable. We know that you can get your supply. So I expect contracted gas from Australia to fetch a premium to what spot markets, when they normalise, to what they should be able to do, because we're a safe haven.
Yeah.
And that's not limited to oil and gas. You can expand that to a number of other commodities. You can expand it to aluminium. You can expand it to nickel and all the battery materials. Russia's a big supplier of nickel. I think it's 20% of battery grade and 7% of refined nickel. So there's no reason why Australia can't do particularly well out of this, because we are a safe haven. We have the resources. I think we should do particularly well. So if you look at Tesla, where they're going to want to contract, they're contracting with a lot of Australian suppliers.
Yeah.
So it's an interesting dynamic, and how it plays out, we're probably going to be wrong. But timing is the big question. And I think it's probably going to take a lot longer for the world to transition to green energy, particularly from developing nations standpoint versus that of developed nations.
John, thank you for talking to Fear and Greed.
No problem.
That was John Ayoub, WAM, Wilson Asset Management, WAM Leaders Portfolio Manager. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.